Hey everyone, I'm David Finz, and on this episode of the Cyber Insurance Imperative, we're going to review the state of the cyber insurance market as we head into 2023. And this is really a question of whether you believe the glass is half full or half empty. In one corner, you have Lindsay Nelson, the cyber development leader for CFC, who recently stated on LinkedIn that, quote, 2023 is the year that cyber insurance will emerge from its awkward teenage phase into adulthood, end quote. In the other corner is Zurich CEO Marco Greco, who was recently quoted in the Financial Times of London as saying that cyber was on the verge of becoming uninsurable. Regular viewers of this program know where I come down on this question. In my experience, there's still an appetite for cyber on the part of the underwriters. They're just getting smarter about assessing the risk and pricing for it. And I know that this has been a pain point for our clients, but the fact remains that the product needs to go through some changes if it's going to remain viable. As I've said before, if insurers can't write cyber insurance profitably, they won't write it at all. The job of the broker is to help differentiate our client and present them as a better risk, and then to make sure that the policy performs when they do have a claim. So let's look at the numbers. You know, there's an old saying, there's lies, there's damn lies, and then there's statistics. And obviously you can pick apart data and spin it any way you want, but I think there's some good news to be found in a recent report from the National Association of Insurance Commissioners. Each year, the NAIC releases a report on the state of the cyber insurance market. And this year's report acknowledged that the underwriting process has become more demanding for businesses, that insurers are not only drilling down on the security controls a company has in place, but they're also focusing on the risk presented by poor vendor management, since a lot of claims are coming out of security compromises at the insured's service providers. This approach is paying off. For 2021, the most recent year that the NAIC had data, direct written premium for U.S. insurers of standalone cyber coverage increased by 75% to more than $4.8 billion. Throw in the package policies, and we're talking about a $6.5 billion market. But that only matters in the long run if they're getting better at underwriting. And they are, slightly anyway. The loss ratios for the top 20 cyber insurers inched downward from 66.9% to 66.4%. That's still higher than where it needs to be, but at least it's moving in the right direction, and the NAIC credits better risk selection and stricter policy terms and conditions with the improvement. But it's even more telling to look at the performance of individual carriers. 10 of the top 20 insurers had loss ratios below 60%, which is considered the threshold for profitability. And then there are the managing general agents that don't even make the top 20 in their own right, but utilize the paper of several of those insurers, and they're having a huge impact with small and mid-sized businesses. They're partnering with our clients through continual monitoring of the insured's network and connecting them with cybersecurity firms that can help them get the controls in place that they need to reduce the likelihood and severity of these attacks. Now, as far as what is driving those attacks, ransomware remained a big problem in 2021, with attacks growing by 93% year over year. But I can tell you that in 2022, those seem to have leveled off somewhat. Blame it on the war in Ukraine diverting the attention of some of the biggest ransom gangs, stepped up enforcement by the FBI and others in clawing back some of the payments and apprehending some of the criminals, or just heightened awareness on the part of businesses. Whatever the case, the ransomware epidemic, like data breaches, isn't going away entirely. But what we've seen over the past several months is a rise in social engineering claims, where hackers pose as a trusted merchant who contacts a customer to update payment addresses or account or wire instructions. When the insured makes the payment to the imposter, their vendor may still demand payment, and that is a loss that may be covered under the insured's cyber or crime fidelity policy. When the insured's customer misdirects the payment, it leaves the insured with a bad receivable on their books. This is known as invoice manipulation, and there's a sublimit available under a cyber policy, but it's typically not in the base form, so brokers will need to ask for it to be added by endorsement. Another growing problem is utility fraud, also known as cryptojacking. Now, if you haven't heard of this, it's the subject of a recent episode I just did. And it basically comes down to someone hacking into a network to siphon off electricity and computing power, usually to mine for Bitcoin or some other cryptocurrency. And much like invoice manipulation, the coverage is sublimited and usually available only by endorsement. Now, I want to touch briefly upon the expansion of the war exclusion because back in August, Lloyd's issued a market bulletin that directed its syndicates to stop covering state-sponsored cyber attacks. Some critics took this as proof that the London market for cyber was evaporating, but when you read the fine print, that's hardly the case. For starters, an attack must be launched from one nation, targeting another nation, and be severe enough to compromise the functioning or the security of the targeted nation state. We haven't seen an attack in the private sector yet that would qualify under this standard, not even the famous NotPetya malware of 2017, which was aimed at Ukraine but ricocheted around the world. And Lloyd's told the underwriters that a process for attribution needs to be clearly defined in the policy. Absent one government blaming another, it may prove difficult for an underwriter or adjuster to make that call. So I'm not overly concerned about this restriction, although we have started to see similar efforts by U.S. underwriters to address what they consider to be systemic or catastrophic risk or widespread events. The last point I'm going to touch upon is relating to the marketplace for regulatory coverage. As you're probably aware, California has led the way in data privacy legislation, and other states are beginning to follow suit. The idea that your personal information is your property and worthy of legal protection has been the law of the land in Europe at least since 2017 with the passage of GDPR. But it's becoming the reality here in the US as well. And defending these regulatory proceedings is not only costly, but these cases can drag on. And that makes it harder for underwriters to close the books on these so-called long-tail exposures. Because of this, some underwriters are calling for an end of coverage for these proceedings, or at least for the fines and penalties. This is something brokers will be pushing back on, since it's typically our largest clients that get caught in the crosshairs of regulators when they have a claim. Now, Alliant has made major investments in cyber talent over the past year or two. Scott Takaoka and Adam Rao, who recently joined our Imperium Consulting Group, are filling a critical need around helping our clients not only to quantify their cyber risk, but also to determine what's the best spend of their cybersecurity budget in terms of reducing premiums and losses when they do occur. And our recent hire of 3 senior cybersecurity consultants, Jay Stamfel, Brendan Hall, and CJ Dietzman, will enable us to assist clients in getting those controls in place, whether by directly providing those services or through our relationships with strategic partners who can enhance the cyber maturity of our clients. Add to that the claims advocacy and policy wording capabilities of our specialty claims and legal team, headed up by industry veteran Steve Chappell, and you can see that Alliant Cyber has moved beyond the insurance transaction to become a full-service cyber risk advisor for our clients. And if your broker isn't offering this range of services, maybe it's time that you discover the more rewarding way to manage risk. So DM me on LinkedIn or email me at david.finz@alliant.com, and we can start by having me look at your current policy and offering suggestions for improvement. Thanks for watching.